Joining me now as well is Mark Zandi, chief economist at Moody's Analytics. Mark, there's a narrative out there that the administration is fond of saying tariffs are not inflationary, just a one-time price bump up. But we've got this new data. What's the data showing about tariffs thus far? How long is it going to take before we get a more definitive answer?
Inflation prices are rising. It's been slow coming for lots of different reasons. The front loading of imports, the fact that the tariffs are up and down all around, and business people just don't know where they're going to land and are nervous about raising prices, losing market share before they have a sense of where the tariffs are going to land. You know, some big companies are probably pretty nervous about the political environment and raising prices in that kind of environment. So a lot of things going on, but, you know, it's happening. We know American companies and consumers are paying the bill because you can see it in the tariff revenue. It's quite substantive. So we're paying for it. So far, most of it's been by businesses and lower profit margins, but I don't think that's going to continue for very long. And we're going to see more of a translation through to prices that we pay as consumers. So inflation is up. You know, Steve said 2.8% on the core PCE deflator. That's well above the Fed's 2% target. And the direction of travel here is very clear. Prices are going higher. Inflation is going higher. Now, whether it turns out to be one-off or more persistent, that's to be determined. But, you know, when you're in the middle of inflation rising, it's pretty difficult to say, OK, it's time to cut interest rates. And I think that's the kind of the conundrum the Fed's in. I don't think they can cut rates with inflation moving higher unless the job market really weakens.
This is a really difficult one to figure out, Steve Liesman. We know that the president made that trip to the Fed, the now infamous hard hat picture. He said he thought that Fed Chair Powell would do the right thing in Trump's eyes, which is lower rates. But we've gotten no indication that the Fed is headed that way thus far for some of the reasons that we're talking about. What kind of weakness do you think it would take to convince the Fed ahead of the tariff clarity that rates need to be lower? And what does history tell us the impact on equities might be?
So I think that you would have to have substantial rise in the unemployment rate. Not much if you went up to 4.3, 4.4, 4.5, which would still be low, but it would really show a direction to the Fed. If payrolls were down substantially in the 50,000 or zero range, the Fed would probably act in those situations. But, John, I want to go back to your question to Mark, which I think is really interesting. You said, well, tariffs could be a one-time price hike. We're still in the middle of the one-time, right? So the idea that somehow we went through the one-time price hike in May or in June, the president is still levying tariffs. We just learned about new tariffs yesterday. Some of the tariffs on India, South Korea, they haven't worked their way through the system. Goldman is counting a 7.4 percentage point increase so far in the average tariff rate. They think it's going to 14%. So this is the problem. The market operates on a I got to know this second timetable. And the economy doesn't work that way. It's going to take time. You heard Mark Zandi say that companies are taking it on the chin right now in profit margins. I'm looking at an amazing list of comments from companies so far. Let's see. Ford said, what was it? GM said a $1.1 billion tariff hit. Ford said $2 billion. How long can they operate this way before they start to pass it along? This one-time price hike, I don't know, maybe could be 6 months.